Next module is enterprise risk management. Risk is inevitable part of any organization. Risk kaadu, risk. Risk is inevitable part of any kind of business. So when it is inevitable, you have to manage it. You have to manage it. So as an entrepreneur, the basic difference between an entrepreneur and a laborer is labor does not have any sort of risk, but entrepreneur bears all the risk. So when he knows that he needs to bear the risk, he should be aware of different tools and techniques available for management of such risk. So in this chapter, we are going to learn about risk management. We are not concerned about uncertainty. Generally, uncertainty and risk are used as interchangeable words, but both are not one and the same. Uncertainty is completely unknown to you, Nana. It may or it may not happen. For example, you may earn profits or you may suffer from loss. That is uncertainty. What do you mean by risk? I know that I am going to earn profits, but how much? Will the actual profit will be equal to estimated or less than that? If the actual profit is less than estimated, that means it is a risk to you. It is a risk to you. When you invest in shares, you know that you are going to get some return. But is this return on par with your expectation or less than that? If it is on par or above, that means you are in good position. But if the actual risk, actual interest is less than what you are expecting, then you are suffering from risk. So we need to focus on risk rather than uncertainty. Okay? So risk plays a very important role. Risk plays a very important role. So I hope you have understood the difference between uncertainty and risk. So a small case study is given at the start of the chapter to help you understand the meaning of risk and how people will try to minimize their risk. So when you have time, please go through that content. Okay, this entire thing is meant for self-study. Introduction, risk management, understanding of financial risk, and basing on that we have one case study. You please go through it once when you have time, Nana. Okay, I'm straight away going to jump into question number 1. What is that one? Write about classification of financial risk. When we talk about risk, it is basically classified into 2 types: systematic and unsystematic. Systematic means it's common in the system. It is common in the system. Now when we talk about system, it is nothing but economy. It's common in the economy. That means it affects everyone in the economy. So that means we can't do anything about that systematic risk. The maximum that we can do is that we can adapt our business according to that particular risk. That is called as systematic risk. Systematic means common to that particular system. System means economy. Unsystematic means it is not common for everyone and it varies from organization to organization. Example for systematic risks are stock market crash, stock market, exchange rate, interest rate, change in interest rate, change in interest rate. When RBI changes interest rates, each and every business organization gets affected in the economy. That is systematic risk. You have to adopt your business. You can't do anything about that, Nana. Government policies. Is it systematic or unsystematic? Systematic, Nana. Am I clear, Ra? Credit risk or solvency risk. It is systematic or unsystematic? Unsystematic. It differs from organization to operational risk. It differs from organization to organization. So the entire risk element is divided into 2 parts: systematic risk and unsystematic risk. As an entrepreneur, my focus should be more on systematic or unsystematic? Unsystematic, because it is unique to my organization. When it comes to systematic, you have common solution for everyone. But when it comes to unsystematic, you have to understand the problems that are there in your organization, the risk that your organization is facing, and basing on that understanding, you have to frame your own policies. So in this question, we are going to learn about it. Am I clear, Ra? I hope you have understood the difference between uncertainty and risk. Best example for that one, when you're doing business, you don't know whether you're going to earn profits or losses. That is called as uncertainty. You are uncertain about it. You don't know whether you're going to enjoy profits or suffer from loss. That is uncertainty. What do you mean by risk, sir? You know that you're going to get profits, but how much? That is called as risk, Nana. In simple layman terminology, risk means nothing but loss. Risk means nothing but loss. You were expecting 10% profit. You got 8% profit. How much profit you lost? That is risk. That is risk. And generally when we talk about risk, we discuss in terms, when we discuss it in negative aspect, not in positive aspect. We discuss the risk in negative aspect. That is my example. You were expecting 10% return from your business. You got return. That means you earned profit, but it is only 8%. That means actual return is less than what you have expected. This deviation is nothing but risk. Okay, so you need to reduce this risk as much as possible. To reduce this risk, first you need to understand the risk. First you need to understand it. So in question number 1, 2, 3, we are going to focus on these things now. What do you mean by risk procedure? To manage risk, what is the procedure we adopt? First question is about classification of risk. Systematic risk and unsystematic risk. Okay. Let us go through this question, Nana. Who has a student mic? Pass on, Jira.
Write about classification of financial risk.
Okay.
Classification of financial risk. In the business world, risk
Connotes meaning.
Meaning the extent to which any selected action or initiation lead to some undesirable outcome. 1 minute,
Nana. So here the key point is there is an outcome result, but it is not as desirable. It is undesirable. Okay, Nana, is also considered within. Okay, next. In finance,
parallel risk is categorized from various perspectives. In the following lines.
In finance parlance, comma, that means in finance point of view, risk is categorized from various perspectives. The following lines briefly categorize the financial risk is taken up for discussion. So from broader perspective, financial risk is classified as systematic risk and unsystematic risk. So when first let us see the systematic risk. In the first para, they have clearly mentioned what is meant by systematic risk. Teja, continue.
It occurs due to macroeconomic factors.
Okay.
It is also called market risk or non-diversifiable or volatility risk, as in beyond the control of specific companies or individuals, and hence cannot be diversified.
Okay, Nana. So it is beyond the control of a company or individual. That means it affects everyone in the organization. When it is affecting everyone in the company, when it is affecting everyone in the country, that means no single company or individual can control it. Okay, so effect is same for one and all, Nana. All investment
and securities suffer from such a type of risk.
Okay.
One cannot eliminate such a risk by holding more number of securities.
In simple terms, when it comes to systematic risk, you need to simply adopt your business. You can't control it. That means you can't rectify it or you can't eliminate it. You have to adopt your business. You can't do anything about it, Nana. So simply by increasing number of shares, you can't eliminate such kind of risk. It is categorized as first one.
Interest rates. The market interest rate varies and can negatively impact the entity. Entities hold financial assets in the nature of fixed interest bearing securities.
Okay.
This mainly impact the fixed income securities and bond prices. Present value of the bonds are inversely related to the interest rate.
We all know this, Nana. The bond value as well as the interest rates are inversely related. That we have come across in FMRA. C equal to 1 by C by 1 plus R to the power of N. As R changes, the present value of the bonds will also change, but in inverse relationship. That means if interest rate increases, present value of bonds will decrease. Present value of the bonds will decrease, Nana. So when you are holding bonds as an asset and the value decreases, automatically your wealth will also decrease. So interest rate will have that kind of impact, Nana. So it is common for everyone in the economy. Next, market risk.
Market risk. Variations in price sparked off due to real social, political and economical events are referred to the market risk.
Right, Nana. Here you can remove real term. Variations in price. Sparked off means nothing but started. Variations in price started due to social, political, economic events are referred to as market risk. It is basically the tendency of security prices to move collectively. That means we are talking about change in stock market.
For instance, it is in the falling market.
In the falling market, the stock prices of even the best performing companies drops. When stock market crashes, there is no exemption for any one particular company, and almost all shares will crash. The crash will be more in some shares, and the crash will be or fall will be less in some other shares. But almost all the shares will fall. Okay, all that is what they are saying. When we talk about market risk, it affects every company in the economy. When BSE, NSE crashes, I'm not saying fall, and I'm saying crash. Crash by 2000, 3000, bloodbath అంటాం దానే మనం. బ్లడ్ బాత్ అంటాం, టెక్నికల్ టర్మ్ అదమ్మా. అంటే కంప్లీట్ బేరిష్. ఫర్గెట్ అబౌట్ బుల్లిష్ నానా. Bulls have fallen prey to the bears. Right, Nana. So change in stock market. Coming back to the point, Nana. So when the stock market crashes, it affects each and every company. Conventionally, market risk accounts to about 2/3 of the total. Out of all the systematic risk, this is the most important system. It is the one which affects every company in the organization the most. 2/3, Nana. Next, purchase power risk. Here we are talking about inflation. Inflation. Purchasing power means we're talking about inflation. Are you able to follow, Nana? If there is inflation, what will happen to your purchasing power? Can you purchase more or less? When your purchasing power decreases, automatically your standard of living will also decrease. Here they're talking about this, but they're linking up this purchasing power with investment now. Okay, generally first we consume, then we invest, not the other way around. First we consume, then we invest. That means whatever the amount that you were able to save on consumption will be invested, isn't it? Isn't it? As soon as you earn salary, you're not going to think about investment, you're going to think about consumption expenditure. Once you have savings or once you have consumed to a certain extent, then you will think about investment. Because consumption is about present, investment is about future. Now just imagine if the price of goods and services increases, what will happen to your consumption expenditure? It will increase. What will happen to your savings? Decreases. Investment also. This is common to everyone because inflation hurts everyone. Not only rich, but also poor. Forget about poor. It will also affect the rich. It hurts everyone. So inflation is a systematic risk because no one is exempted from it. Everyone will suffer. The same thing is given here also. Uncertainties of purchasing power is referred as risk due to inflation. If investment is considered as consumption sacrifice, then a person purchasing securities forgoes the opportunity to buy goods and services for so long as he continues to hold securities. Very technically given, Nana, but meaning is one and the same. I have explained from consumption point of view, they have explained from investment point of view. For example, if I invested 100 rupees, the opportunity cost of this investment is consumption expenditure. That means if I invest, I can't consume. If I consume, I can't invest. But that is what they have explained here. Okay. In case the prices of goods and services increases during this period, the investor actually loses the purchasing power because he can't purchase more. Quantity will decrease. The investor expected return will change to change in real value of return. Obviously, inflation will have an impact on expected returns. When your purchasing power decreases, obviously you will expect more return from your investment. When purchasing power decreases, for example, let me rephrase it now. Because of increasing prices, rather than purchasing goods and services, you are using that money for investment. So opportunity cost of investment is purchasing power that you have lost. Opportunity cost of investment is purchasing power that you have lost. And here the price of goods is increasing. That means your opportunity cost also increasing. You want to compensate this opportunity cost from investment. So obviously you will be expecting more returns from your investment. Am I clear? So if I'm sacrificing 100 rupees, I need to make sure that I'm earning 100 rupees here. That's what they have said now. Because of increase in prices, if my opportunity cost increases, I will be expecting more return from my investment. That is what they have given. D point, foreign exchange risk. It affects everyone. And moreover, it's not an operating aspect. It's a non-operating aspect. Foreign exchange. Foreign exchange, no. That means because of this foreign exchange, you may earn more in domestic currency or you may earn less in domestic currency. Domestic currency. I'm talking about domestic currency. Let me take a simple example. At the time of writing invoice, $1 equal to 80 rupees. At the time of receiving payment, at the time of raising invoice, I have provided some services to US client. I have raised an invoice. Obviously, I will raise invoice in dollars. I have provided services to a person living in USA. Now, I need to raise an invoice, right? I will be raising that invoice in rupees or dollars? Dollars, because he needs to pay me in dollars. At the time of raising invoice, $1 was equal to 80 rupees. At the time of receiving payment, $1 equal to 82 rupees. Yes, but it is because of operation or non-operation. And it affects not only me, but everyone in the economy. Isn't it, Nana? And generally, when we talk about exchange rate risk, it is based on exports and imports. Exports and imports. That means we're talking about appreciation of domestic currency or depreciation of domestic currency. From $1 equal to 100 rupees, if it becomes $1 equal to 150 rupees, from $1 equal to $1 equal to 100 rupees, if it becomes $1 equal to 150 rupees, it is called as depreciation of rupee. Depreciation of rupee. And these things depend on exports and imports predominantly. Am I clear, Nana? For example, if imports are more, imports into India are more than exports. If imports are more than exports, means net payments from India will be high or low. And you need to make payment in rupees or dollars. So you will be demanding dollars. When you demand dollars, value of dollars will increase, value of rupee will decrease. And when these things happen, no one is exempted from it, Nana. Everyone will get affected, either directly or indirect. Companies who are dealing in exports and imports will be directly affected, and thereby others will be indirectly affected. The same thing is given here also. Read it, Nana.
Foreign exchange risk. The risk stems from the uncertainty in the changes in the value of the currencies. So it affects only the companies during foreign exchange transactions like exports and import companies.
Okay, Nana. Next, political risk. Government policies. Political risk. Because of instability in the government or government policies, definitely it will affect everyone in the organization. Country, Nana. Read it, Ram.
Political risk. Such a type of risk occurs primarily due to political instability in a country or a region.
Nana, political instability does not mean collapse of government and forming of new government regularly, Nana. Change of policies or shift in policies also. It also leads to government instability. Instability. Okay. It's a subjective case. Yeah. The demonetization and instability. Sometimes political reforms may also cause instability if they are not done properly. GST is the best example for that one. Political reform, it's a reform, but because of lack of proper implementation, we are not getting the results which we have expected. We will get it, Nana. Ultimately, we will get it. But as of now, there is a delay because of that lack of proper implementation of it. Okay. Demonetization under such example. Okay, basically these are called government failures. Why, sir? Government is there to solve any problem in an economy. But instead of solving a problem, forget about the existing problem. If it creates a new problem, then we can say that government has failed in its objective. The objective of the government is to maintain stability. One of the objective of the government is to maintain stability. How you can maintain stability? By solving the existing problem. Solving means reducing the impact. You can't solve, you can't find 100% solution for every problem, Nana. But you have to make it socially acceptable. Okay, it should not be extremes. It should be at a moderate level. Then it's okay. So government is there to do that, to maintain stability. But if the government policies itself create instability, then we will say it as a government failure. In such a situation, we will suffer from political risk. Political risk, Nana. For instance, if a country is at war, then the companies operating there would be considered risky automatically. Okay, forget about war now. If the government keeps on changing the policies, the government, for example, this is an election season to attract domestic companies or small MSME sector, government decided to impose ban on imports. Impose ban on imports. Now, for time being, you may attract or you may please MSME domestic companies, but it will have a major impact in the long run. Because what you are doing, you are isolating our country from rest of the world. We need imports to grow. We need imports to grow. So we can't isolate ourselves from other countries. But for the sake of winning in the election, if the government comes up with that policy, that is banning imports or restricting imports, it may be able to fulfill its objective of winning the election, but it will definitely have a long-term negative impact on the economy. These are called as political risk. Okay, so all these are systematic risk. Next, Nana, unsystematic risk.
Unsystematic risk. It is a portion of total risk which results from known or controllable factors. It refers to the portion of the financial risk of an entity which is caused due to factors unique to or related to entity or the industry.
So these risks are caused due to factors which are uniquely related to that particular company. Okay, that means these risks differ from company to company. Every company suffers from credit risk, but it's not same for everyone. Best example, not all companies have same credit rating. Not all companies, every company gets a credit rating, but it's not same for everyone. And even though two companies have same rating, it is not because of same factors. So these things differ from company to company, and these are related to respect to company. That means these are controllable to a certain extent. So first one, these are categorized as first one.
Liquidity risk.
Liquidity risk, nothing but we're talking about cash flows. Cash flows. Liquidity plays a very important role. So are we able to generate sufficient amount of cash as and when required or not? Funds or cash now. So liquid risk means we're talking about cash flows. Read it, Nana.
It is that portion of an asset's total variability of the return which results from price discount given or sale commission paid in order to sell the asset without delay.
You are in need of money, so you wanted to sell an asset. If you are able to sell that asset without offering any discount, that means you have less liquidity risk. Once again, I'm repeating the example now. You are in need of money. Generally, every business will be in need of money. Now, businesses have found out that they have an asset which they are not using it. So they thought of selling it off rather than borrowing from banks. Let us sell it off. We have bought a piece of land now, which is some other place. As often I wanted to invest some money in my business. Okay, I'm not using that land. My analysis so that by selling off that land, investing that money in my business, I can earn more. Later on, I can purchase a bigger land. So looking after all these analyses, I decided to, rather than borrow from banks or raise money from the market, let's sell off this particular piece of land. Okay. Now if you are able to sell off that land without reducing the price or without offering any discount or whatever the case may be, that means you have less liquidity risk because you are able to sell it easily. But if you are finding it very hard to sell that piece of land and you ended up offering more discount, that means you have high liquidity risk. That's what that I explain. I have taken the example of land. Here the example will be nothing but shares, bonds, etc. If you are forced to sell your shares at discount or bonds at discount, that means you have high liquidity. Why you are offering discount? Because at par no one is willing to buy it. At market price no one is willing to buy it. That's why you are forced to offer some discount. So you suffer from liquidity risk. Next, Nana.
It is a situation wherein it may not possible to sell the asset.
Assets are disposed of double F nana. Assets are disposed of or sold at great inconvenience and cost in terms of money and time. That means you find it very difficult to sell that asset. Not only you have to wait for long period of time, moreover you need to offer huge discount to sell off that particular asset. Any asset that can be bought or sold quickly is said to be liquid. We know that, Nana. That's why we have categorization of assets called as current assets, which you can sell it off easily, isn't it, Nana? Failure to realize with minimum discount to its value of an asset is called liquidity risk. If you are unable to sell that asset without offering a high discount, that means you are at liquidity risk. A nominal discount, acceptable. 2%, 5% discount, acceptable, none. But if you ended up offering more than 5%, 6%, it depends on the industry, okay? Market conditions. Under market, 5%, no good 5%, acceptable. Generally, the discount offered in the market is 5%, but during that particular point of time, you ended up giving 8% or 10% discount. That means you are at risk, liquidity risk. Next, Nana, credit risk.
Credit risk. It is also known as default risk.
Default risk, na solvency. We're talking about credit worthiness. We're talking about credit worthiness of the company. And this credit worthiness plays an important role at the time of raising capital, especially in the form of borrowings. If you want working capital, the banks will look at your credit worthiness. If you're able to easily raise the working capital from the banks or borrow money from the bank, that means you are a credit worthy company. Now, given you have constructed some building and you're getting regular rent from that, now, then bank will look into that. Not only you have an asset, but you are getting income also. So asset as well as the income that you are getting regularly, that plays a very important role. Rundu chostai. I may have 10 crores of asset, but regular income is zero. Revenue is zero. No bank will be willing to offer loan, Nana. NBFCs will give loan for any case. Talking about proper banks. Assets nunchi income vastundi. Regularly you are getting 5 lakhs, 6 lakhs of rent every month. Then banks will not only have an asset, but also are getting a regular income. So in this way, generally credit worthiness is decided. So basing on these conditions, if banks decide that a person or a company is a credit worthy person, they will easily offer loans. And moreover, that person will be in a position to negotiate the interest rates also. He will determine the terms and conditions, not the bank.
Credit risk. This is also known as default risk. This arises due to default in meeting the financial obligations as and when due for payment.
Due for payment. If you fail to meet your financial obligations, that means you have become a defaulter. So that's a credit risk, Nana. Next round.
The non-payment of interest and principal amount in time will increase the risk of insolvency and
bankruptcy cost. Okay. Next, Nana. Operational risk. It is completely an internal risk, Nana. The operations will differ from organization to organization. When we talk about operational risk, it involves risk of a system or a procedure, technology, human failure, omission or commission of errors, all these things, Nana. Okay, so this is operational risk. And every operation is bound to suffer from certain risk. Every operation is bound to suffer from certain risk. Let me take example of masterminds. In masterminds, the major operation is connecting of classes, right? Connecting of classes. On paper, it will be something, but at the end of the day, we may do something else. We means as a faculty and non-teaching staff, we may do something else. They will ask us to complete the syllabus by 100 hours. We'll take 120 hours. Definitely, there is such risk involved. It is not unique to this. It is common to every organization, but differs from organization to organization. So operation risk is a common phenomenon in any business. Nana. So operation risk arises primarily due to deviation from planned. Difference between allotted hours and actual hours. Difference between allotted hours and actual hours. Allotted hours are 100 hours. Actual hours are 90. Okay, no issues. Allotted hours are 100. Actual hours are 120. It's a problem. 105 or 110 acceptable. 10% deviation acceptable. But 120 means more than 10%. Okay, Nana. So this is called as operational risk. You will be comparing actuals with planned. And these actuals and planned are not common to every organization. It differs from organization to organization. Process will be same in all the organizations. The same process will be done in Chaitanya Narayana also. But ours will not be same. Ours will not be same. There they will deal in different subjects. Here we will deal in different subjects. The procedure of imparting knowledge is completely different there and here. Nana. So obviously, planning and actuals will be one. The process will be same, but the numbers will completely differ. Next, Nana, of system, procedure, technology, human failure, omission, commission of errors. It also arises due to inherent fault in the system, procedure, technologies that affect the revenues of the organization adversely. What do you mean by inherent faults? Unavoidable errors. And without students, I can't start my class. And if we treat it as abnormal, the students will not accept it. They want it to be treated as normal. So if we take such kind of things into consideration, you can't complete the syllabus in 100 hours. So every process has these unavoidable losses, unavoidable faults. These are normal. You can't do anything about it. Okay, you have to accept. If the loss is beyond this point, then it becomes abnormal. 5 minutes delay. Right. As the activities of the organization change due to globalization and integration, new factors are continuously influencing and increasing the operational risk. These are some of the risks, Nana, but in globalization, several factors keep on changing. The major risk which every organization suffers from is technological risk. Technological risk, Nana. Now, when it comes to technological risk, there's a problem here. Should you treat it as systematic or unsystematic? Companies want to treat it as unsystematic. Companies want to treat it as, because not all organizations use same type of technology. See, when it comes to technology, there is no compulsion that you have to use advanced technology. Even though an advanced technology is available, there is no compulsion or there is no force to use that advanced technology. First, you have to decide whether the technology is appropriate or not. If it is appropriate, then you have to go through cost-benefit analysis. What is the cost of using the technology and what is the benefit that I'm going to get? Then you have to take a decision now. Without doing it, if you simply blindly adopt an advanced technology and if you don't get any return, you may suffer from losses. Okay, so for me, the technological risk is nothing but operational risk. Okay, so that's basing on this question, a flowchart is given below. Okay, that you can go through it on your own now. Question number 2. Write about risk management process. Now, one thing we have understood is risk is an inevitable part of any business. Now, when you know that you are going to suffer from risk, it is better to be prepared for it. You should be prepared for it. That means we have to design a process where we are able to manage the risk. Now, the point here is that if you want to manage anything, first you have to measure it. Without measuring, you will not know, and without knowing, you will not be able to manage it. Okay, so when it comes to risk management process, what are the terms that we need to focus on? First one is likelihood. How frequently we are going to suffer from such risk? Likelihood. And that is the reason why in most of the cases, risk is mentioned as a percentage, probability. When we talk about risk, we mention its probability because we're talking about future, right? So likely, that's called likelihood. Now, what is the chance of suffering from such risk? That is likelihood. Now, when you know that this is the chance, there is 60% chance of suffering from suffering such risk, what is the impact of such risk on the organization, business? Impact, etuvanti impact untundi. More impact, less impact. I came to know that this particular event is going to affect my organization. How much effect or what sort of effect? Okay, and last one is risk exposure. Okay, it will impact my organization. There is 60% probability that the event may occur. If that event occurs, my organization will suffer. Now, when my organization suffers, Nana, to what extent? Risk exposure, measuring it. To what extent? So when you talk about risk management, these are the 3 key things every management should look into it now. First one, likelihood. what is the chance of suffering from such risk, and how it will impact my organization. Now, once I concluded that it is going to impact my organization, what will be the loss, percentage of loss? Risk means nothing but loss. Please go through question number 2, Nana, on your own. Make it faster. Uncertain, complex, ambiguous. What do you mean by an event, sir? A transaction. A policy change is an event. Okay, a transaction may be an event. Okay. Without taking risk into consideration, if you come up with a policy or a strategy, if you define a strategy, it will be ineffective. Okay, it will not be that effective if you do it without taking risk into consideration. So in place of using ineffective, they have used the term dampen. Okay, so this influences the outcome of the decision making process and often dampens the strategic goal of the organization. So whatever the goal that you have fixed without taking risk into consideration will be ineffective. It means there is no guarantee that you are going to achieve it. Thus, risk management, which is an integral part of overall management of the organization, has gained considerable importance in the new business environment. That's what I was explaining from the first point, Nana. Risk is an inevitable part of any business organization because no one knows what is going to happen in future because everything keeps on changing. Basic thing, consumer taste and preference itself changes. I'm not saying consumer is the only thing that changes. No. Out of all the factors, consumer is the most important factor. Itself keeps on changing. Okay. So when things keep on changing, you can't use the same policy. You can't stick onto the same strategy. You can't use the same plan, same strategy. You have to change accordingly. When you keep on changing things, there is a risk element involved in it. What is the risk element? You may achieve or you may not be able to achieve whatever things that you are able to expecting now. So when it comes to risk management, you have to focus on these three things. What is the first one is likelihood. What do you mean by likelihood? And likelihood of occurrence of event. That means what is the probability of that particular event or transaction occurring? 50% probability or 60% probability. See, my request is before going through or if you have completed going through these 3 points, Nana, go to the case 1, which is given in the introduction. Go through case 1, which is given in the introduction. There you will see, Nana. In that case, they have clearly mentioned the probability for the risk. They have clearly mentioned the probability for the risk, Nana. Tinkuji edo ichadu chudandi akkada. Random reading ichandi saripotundi. You will understand. What do you mean by likelihood? Will today be the sunny day or rainy day? Don't know about it now. You need to go for probability. To get probability, you need to go through past data. Okay, past data చూడాలన్నమాట. So last year time ki was it rainy or sunny? If it is sunny, I will sell ice creams. If it is rainy, tea. అక్కడ టీ ఇచ్చాడు. బజ్జీలు అంట. What do you mean by likelihood, Nana? Is the possibility that an event may occur. Possibility means nothing but probability. What is the probability of that particular event occurring? Okay. Likelihood can be described using qualitative terms, Nana. High likelihood, less likelihood, or moderate likelihood. Okay. Or you can express it in terms of numbers also. That is not percentage. Or alternatively, likelihood can be described using quantitative measures such as percentage. First preference should be given to quantitative expression. If that is not possible, then we go to qualitative expression. Because when it comes to decision making, we need data. When we talk about data, Nana, we focus on quantitative expression. Okay. Next is impact. Okay. There is 60% probability of that particular event occurring. No. There is no rule that even if that event occurs, it should affect my organization. That affecting is called as impacting. ఆ ఈవెంట్ జరిగినంత మాత్రాన ఆర్గనైజేషన్ ఎఫెక్ట్ అవ్వాలని రూల్ ఏమీ లేదు. When we talk about affecting, Nana, here we're talking about impact. What sort of impact that event will have on my organization? Okay. So impact, Nana, magnitude of impact or degree of impact represents the effect that an event will have on an entity. Event means nothing but an episode or transaction. It will be more easy to take it as a transaction now. Transaction. If that transaction or if that change occurs, what sort of effect it will have on the organization? That is called as impact. Impact can be described broadly, qualitatively, and quantitatively. Entities often describe events based on severity, consequences, or dollar amount. Dollar amount means quantitative, severity means qualitative. Dollar amount means in terms of money. In terms of money, now what sort of impact it will have on the organization? Because of change in GST, definitely it had an impact on every organization. Earlier, the companies which are paying less in the form of indirect taxes, they end up paying more. And companies which are paying very high, Nana, they end up paying less. So impact will be there, whether it's a positive impact or negative impact. It varies from organization to organization. And third one is risk exposure. Okay, that event will impact my company. Because of that event, what is the loss I am going to suffer? That is called as risk. A event na company impact chestundi, and because of that impact, what is the loss I am going to suffer? That is called as risk. In any business, risk exposure in any business or any investment is a measurement of potential. Focus on the term losses. What is the loss I am going to suffer because of that particular transaction or occurrence of that particular transaction or event? Okay. That is called as risk exposure now. Okay. Potential future loss due to specific event or business activity and is calculated as the probability of the event. Probability of the event multiplied by the expected loss due to risk impact. Event T is missing. Once you have completed this question, please go through first case. You can link up this question and the case. No need to remember anything there in the first case. Just go through it. So you will understand how that person analyzed the risk and choose that particular activity where the risk factor is less. Okay. So 5 steps are the identification. First you have to identify what are the factors. There are several factors which will affect the organization. Okay. Then analyze each factor, how it is going to affect the organization, what sort of risk we are facing from each and every factor. Then you have to set it in an order, nothing but prioritizing it. Okay. Then reducing the impact. There is no 100% solution for anything, but the best you can do is you can reduce it. And last one is monitoring. Monitoring is directly related to ever changing environment. As things keep on changing, you need to keep on monitoring it regularly. Okay. These are the 5 steps. Basing on this only, we have question number 4 also. First complete question number 3, Nana. I will stop with that one. Okay. Make it faster. Question number 3.